guys, it's May from Markets with May, and in this episode, we're going to be talking about 4 takeaways from the Berkshire Hathaway Annual Meeting that no one is talking about. Now, it may seem like I'm a little bit late to talk about the Berkshire Hathaway meeting, which happened at the end of April, but it turns out that these 4 items to me were the most important, but I've heard almost nothing about them in the press, and they really should have been an area for conjecture and discussion. So I'm going to go through these 4 items. First item has to do with who attended. The second item has to do with taking risk and what types of risk they felt like was acceptable versus unacceptable. And this hasn't completely played out yet, so there is still time for folks to conjecture and decide whether they agree or disagree. The third thing has to do with the trading environment in February. Currently, the impact of that is playing out in Occidental Petroleum, ticker OXY, but there's a lot more to unpack there that the news just simply has not. And the fourth item has to do with what he specifically said as relates to index funds and passive investment. Now, this has largely been reported all over the map in the news. And in a lot of ways, a lot of folks just didn't understand it, so they reiterated what he said in the past. But that is not what he said at this meeting, and we are going to go through it. Before we get into that, past performance is not indicative of future returns. In no way are we trying to get you to buy or sell anything. And I will absolutely admit to the fact that I am long Berkshire Hathaway and plan on going yet again next year if everything works out for me on the travel front. Additionally, I always appreciate it when you like, share, comment below if you also went to Berkshire Hathaway or are planning to go. And if you subscribe to my channel, I think that would be amazing. All of that helps me know what type of content to create. Now, let's get into these 4 items that are just going missed for some reason. Now, they always report Berkshire Hathaway as the Woodstock for Capitalists event, and I think that's a little unfair in some ways, because although everyone that's there has a crazy appreciation for Warren Buffett and Charlie Munger and what they've accomplished in the investment world, I think it is also equally as fascinating the people that clear their calendar to go there. Now, all of the portfolio companies of Berkshire Hathaway do have a seat in the upfront area right next to the stage, but additionally, the board members go and attend as well, and then certain people that were past board members. So Bill Gates cleared his entire schedule, was there sitting the entire time, as was Tim Cook and also Jamie Dimon. And there were others that were in the audience that you kind of got to see if you were sniffing around. Nonetheless, I named those 3 because those 3 absolutely sat in their seats from the time the meeting began at 8:30 until it ended, which was a really long day. And you got to think, those 3 guys, they got other stuff to do if they wanted to, but they all sat there and listened to these sages speak for the first time in 2 years. And, you know, this really tells you a lot about how respected, how much wisdom is coming out of these 2 sages within the industry. For folks that have never gone, given that Charlie Munger is 98 this year and Warren Buffett is 92, you know, there's not going to be that many more opportunities to see these 2 who really are the very best of the best within this business, let alone some of the best earnings call people that you can ever listen to. So I really do encourage you to go. But I think the most important takeaway from that is whatever was said in this meeting was actually kind of important. And so the fact that the next 3 items kind of went questionably reported is kind of interesting in my mind. So let's get to the second item that I think really got swept under the rug. Now, the second item had to do with 2 risks in the portfolio that Charlie Munger and Warren Buffett wanted to take personal credit for and also potential failure for. And these are 2 fairly controversial names in the portfolio that the press had been reporting in a couple of different ways, and they used the opportunity during this annual meeting to say, no, these were definitely Charlie and me, so the buck stops here. Stop trying to blame anyone else at the firm. Now, that's interesting, the fact that they did that, which I think is fantastic, and also what the 2 names were is also very interesting. Now, the first stock that I'm going to talk about that they absolutely wanted to clarify, take credit for, and answer the audience questions on was Alibaba. Charlie Munger, this is his personal pick. He has been very bullish China and Chinese stocks for some time, and he spoke very directly about the fact that they understood the risks. That was a risk that some people could not bear. They felt that that risk made sense for their investment style and for the long term, and he defended that stock like a champ. Now, Alibaba is definitely a stock that we discuss at Markets with May, and actually as recently as in August, we were talking and discussing about ways that you could use the options market to play this company. But really, the reason that we even look at it is because it is a bellwether within the space, because we are huge fans of Warren and Charlie, so we absolutely do agree with Charlie. Now, if you're a stickler for words, definitely go back to the transcript and have a look at exactly how he said it. But what I loved about the way that he discussed risk, discussed the fact that he knew he was taking a risk here in a very particular way on behalf of shareholders for the long term, but that he thought it was the type of risk that made sense. You just have to appreciate how direct Charlie Munger is when he makes an investment call and just says why he's in the stock. That is really worth understanding about these two and what it means to give them your money. The second place where they talked about risk and taking risk directly in the book on behalf of shareholders was Activision, ticker ATVI. This is actually in so many ways very interesting. Markets with May definitely does have a position in this one, or a diagonal, just because it's a little bit better mathematically to do it that way, but then we bear a little bit of timing risk as well. But I think what makes this one so fascinating is that just before the conference, there's a lot of talk that this was a junior person that was taking the risk and that it wasn't Warren. And then there were some people that were saying, no, it's Warren and all this stuff. And he was like, no, guys, I took this position. Do not blame my junior staff. The buck stops here. It's not like I was asleep at the wheel and didn't know this was happening. Absolutely, I did this. That's the first thing that was interesting about it. Second thing that just made it so interesting is that Bill Gates is sitting right there in the audience the entire time. And you know, yeah, that's its own kind of deal, but it does tell you the man definitely knows Microsoft very well, Activision as well. I'm sure he is constantly reviewing all of these 10Ks. He absolutely took ownership for that. And he said, and I think this one's also worth reviewing if you're a young person or even for myself to just understand how he articulates himself. He really talked about the fact that it was a risk. He knew that it could fail to go through. We never know what will happen with the governmental agencies, but it was one that he felt was the right risk for the portfolio on behalf of investors. Now, the third thing he talked about was Occidental Petroleum. And it's interesting because people really reported after this the size and how much he'd acquired of Oxy by April. But that wasn't really the nuance that he discussed. What he talked about was the fact that it is unprecedented to get 12% of the stock in such a ridiculously short period of time in February. He did not need to go to a broker and do a secondary offering for primary shares to just try to buy in the stock in some funky, strange way where he had to pay excess brokerage fee on top of just market movement. Instead, he was just able to collect it by just being in the markets when it was crazy volatile. And that nuance he sees as somewhat problematic, so he's just going to take every opportunity he can on the names that he would like to own large slugs of. Now, if the point was just that, then I wouldn't be able to say that the press failed to report on this nuance going on with Occidental. But instead, that wasn't his true core of the point. It was the actual ability to buy and the amount of shares and the volatility associated with it that I think really is unprecedented and it's misunderstood. To be able to buy a large cap name with that much, I mean, to get to 12% is a really big number. And then subsequently, at this point, he has 20%. I mean, to get to 20% by just being in the market is something really different and really bizarre about the mechanism of this market. And that's the point the press hasn't even cared about at all. Now, the last point that massively goes missed had to do with his commentary on index funds and passive investment. And this one is kind of a shot at someone, I'm gonna be polite like everybody else and not say it, but his comment had to do with the fact that if you took the top 4 index funds, then given where they are passively invest, the fact that people own S&P, own NASDAQ, etc., But in many cases, it implies that 40% of any given large cap company is in fact owned by a passive investment firm, meaning BlackRock, Vanguard, Invesco, etc. His issue with that is the exact opposite of the capitalism that he believed should exist. Let's unpack that, because that definitely has not been fully unpacked by the press. He talked about this in gross detail, so you don't have to take my words for it. You can absolutely either go back to the transcript or go to the taped recording that is available on YouTube. But to walk through this nuance for you, when you invest in an ETF, you give your money over to an asset manager, and the asset manager then actually has the custody of the shares. So if you buy the S&P 500, if XYZ stock is 5% of the S&P 500, then the manager is the owner of the 5% of the stock, and you are the owner of the asset manager. As this accumulates, though, it means that those asset managers, by virtue of having raised all that capital for that fund, become the single largest shareholders of that stock. And if you've got 4 companies that are really the bulk of this, then when it comes to voting time, they can push the vote one way or the other. That's nuance 1. Nuance 1 implies that the CEOs of major companies, BlackRock, etc., have far more voting power across the entirety of corporate America than they really ought to. And for him, he sees that as a real long-term problem that can only possibly be mitigated at this point by an intervention in some way. And that intervention might be something like asking the SEC to deny passive investors their vote, which probably isn't quite the right answer, but something might need to be done there because of nuance 2. Now, nuance 2, and in some ways, he's telegraphing this because this is something even he could do if he wanted to, given the size of his ownership in some of these companies. All he would have to do to have the majority of the vote, if 40% is passively invested upon, is just coordinate with that 40%. He owns 10% or more, and suddenly he's the majority and can force management to do whatever it is he thinks that they should do. And that also is bad in his mind for corporate America, because it makes a really massive imbalance between the investor and anyone that's a public company. Now, the third nuance, which he spoke about in gross detail, really had to do with the idea that given the power of these passive investors, if they just had some political view, then they could push that political view across the entire S&P 500. Namely, things like, what is the composition of the board, for better or for worse, okay, guys? For better or for worse. This is a guy who's talking that has absolutely had women on his board, all races and colors, etc. So let's not get a little crazy about Warren Buffett, but the idea is that you could force the board to be a particular way, a single guy across all of corporate America, or alternatively force something like ESG across the entirety of America via corporate structures. This is not an insignificant thing to consider, because it does put a lot of political power in one spot. That's all I have for this episode of Markets with May. If you enjoyed this content, please do like, comment, share, subscribe. All of that stuff is so amazing. If you're going to Berkshire next year, I want to hear in the comments below. And if you want to learn more about Berkshire Hathaway in general, I have a whole playlist just dedicated to how to get to the conference, logistics, 10K, etc. So please do check that out. Until next time, be careful out in these markets.